You ever thought to yourself, how do you make money on rental properties? Well, I'm a full-time real estate investor. I buy solely for passive income, and today I'm going to break it down to you and show you exactly how you can make money on a rental property. Let's dive into it.
Welcome to the Smack Fest, the beat down. The SWAT team is here on another beautiful day of shutting the week down.
Hey guys, and for me and for the very first time, my name is William Dauria. I'm a full-time real estate investor. So this channel is dedicated to show you how to get out of the rat race sooner than later. If you like it, be sure to subscribe. So we're gonna start with the number one thing, and that's going to be your cash flow. Now, people ask, what is cash flow exactly? And it's a little bit more than just what you keep at the end of the day. So let's look at it like this. A $100,000 house, let's say it rents for the 1% rule, that's $1,000 per month. Now, let's assume that there is going to be a mortgage on this property, okay? So you're gonna pay your PITI, that's principal, interest, taxes, and insurance. All that's usually built into the payment. So you're gonna make your payment, let's say it's $500 a month. It could be $600 a month, whatever, okay, depending on the area. You make your payment, and then you're gonna pay your property management about 10% per month of the collected rent. So in this case, it would be about $100. You're also gonna account for vacancy, which is about 5%, that's 5% per month is going to be accounted for vacancy, so that's gonna be minus. And then you're also gonna take off, in a reasonably well-kept house, about $100 a month in repairs. Now, you're not gonna do this every single month. You're not gonna have vacancies every single year. Sometimes many, many years in a row, you have no vacancies, but you're going to account for them. At the end of all that, once you've accounted for, say, you got your $500 payment, then you add another $100 a month for property mortgage. Now you're at $600. Now you're 5% vacancy. Now you're $100 repair. So now you're in at, say, I'm not a math genius, $830 a month, right? And it rents for $1,000. You want to make about, give or take, about $100, $200, $300 per door in net cash flow after all expenses are accounted for. Doesn't mean you use them, but they're accounted for. And that is the first way that real estate investors make money. And this is the literal cash flow and what you keep every single month. But that is not why I invest in real estate. And that's not why you should invest in rental properties as well. Because guys, $100, $200 a month, that's all well and good, but the bigger picture is coming up. The next one is amortization, or just debt paydown, because that's a big fancy word, and I'm a college dropout, and we don't like those big fancy words, okay? Amortization is I don't even know if I said that right, is debt paid down, okay? And what debt pay down is the debt that your tenants are paying down. See, you can have 1 property, 10 properties, or 100 properties. You are not paying them down because you are not working 40 hours a week or more, for instance, to pay the rent that pays the mortgage. Your tenants are doing this for you. Okay, so to make more sense, you want to do this at scale. But amortization is just this. When your tenant pays the rent, you pay the mortgage. And a portion of that mortgage is the principal. That is the literal pay down amount that you're dropping every single month. And the interest that you're paying onto that is also tax deductible. Be sure to talk to your CPA. So not only are you getting the cash flow, but the cash that you're still putting out is paying off the property, which is adding to your net worth. The next is the biggest, best, and one of my favorite ones, and that is appreciation. Appreciation is the holy grail of real estate investing. Guys, in 2021 and, well, 2020, here in North Texas, the property values have gone up 15% per year. It is not normal, okay, by any means. 4% a year is about normal, okay? But because my portfolio of just over $3 million has gone up by 15%, I have made about $450,000 per year in appreciation alone. That's it. Now, I wish I had $10 or $100 million of property, and I'm not there yet, but I will be, so be sure to follow my journey. Because as I'm buying properties, I'm rehabbing, I'm renting out, I'm showing you what I'm still learning so you can replicate all of this on your own. So, appreciation is to me, the #1 way to accumulate wealth in real estate investing. That is why, to this day, to this video, I have never ever sold a piece of real estate I've ever bought, ever. Everything I've ever bought, I still keep today, and I don't plan on selling for the near future because appreciation is just this. Say you buy a $100,000 house and it appreciates, let's call it 4%, okay? Because 4% a year is normal, okay? So 4% a year is, guys, easy math, $4,000 per year. You might be saying, well, $100,000 to make $4,000 is garbage, right? Except for you've replicated this again and again and again and again, and you didn't most likely buy that property with your own money. You put a small down payment. The bank used majority of their money, but you get to keep all the appreciation and all the tax benefits. Okay, so leverage is really the name of the game. Okay, however, appreciation over scale makes the most sense. See, at one property, it's hard to justify. At 2 and 3, starts making more sense. At 6, 7, 8, 9, 10 and above, it makes a lot of sense because then you can say, I can make a doctor's income, a lawyer's income by sitting on the beach and getting a sunburn all year round by doing nothing because appreciation alone added more to your net worth than you going to work full time after you went to college for 10 years. That is why I love appreciation in real estate. And it is one of the #1 ways to build wealth because the next part of this, a part of appreciation is once you've accumulated enough equity, don't sell it, you can still pull all that money and keep the property with a cash out refi. Using all of the natural appreciation, yank it out, buy another property, guys. Just the sweet appreciation and debt pay down alone can help you snowball into the next property so much faster than you can ever imagine saving this money on the side. Because real estate investing is all about buying your financial freedom. The next is tax benefits. Talk to your CPA. I am not a CPA. However, when it comes to real estate investing, you can do things like claim, well, the property taxes that you're paying. That can be a tax deduction. The interest that you're paying on that loan can be a tax deduction. There's also one of the most beautiful parts of real estate investing, and that is depreciation. When you claim depreciation on your house. Now, you might be saying, well, the house is going up in value. How am I claiming depreciation? The tax code requires you, as a real estate investor, believe it or not, to claim depreciation, guys. Check this out. You buy a $100,000 house. Every single year, you claim that house is depreciating by a certain amount. Talk to your CPA. It's usually divided by a number of years. So right off the bat, you'll get, let's just say, $4,000 worth of deductions right off the bat for just depreciation alone. So you're claiming legally that your house is depreciating. You're claiming that on taxes, while in all reality, your property value is most likely appreciating, splitting the gap, and your amount that you owe in taxes every year is little to nothing. All these big wigs that are saying we're making, $200 million a year and paying little to no taxes, if they're a real estate investor, it's because they're taking advantage of the system, and you should be as a real estate investor. Also, another key way to do this is the money that you get in, all of the cash flow that you get in, you take a sliver of that for you and your expenses and your day-to-day activities. Take a majority of that, roll them into new properties for new tax write-offs every single year. And another one, and this is the last one, and you're not going to see this everywhere you look on how to make money on real estate investing, and this is buying equity at closing. Now, what this means is, in real simple terms, it's a $100,000 house. It's worth a $100,000 house, okay? You are in it for $75,000. Now, you might have bought it for $75,000 and it's turnkey. You might have bought it for $60,000 and put $15,000 in it. Doesn't matter. You're in it for $75,000. It's worth $100,000. So right there, as soon as you sign the dotted line and say, I now own this property, you also own and just made $25,000 worth of equity. And the net worth game is my most favorite game to chase in real estate investing, because your net worth in real estate investing can explode once you actually look at this, you understand it, and you adopt it to scale. Guys, I hope you enjoyed this video. I hope you learned something. If you have any other questions, you want me to simplify something, let me know down in the comments, and let me also know, where are you in your real estate investing career? How can I help you? Let me know in the comments, and until next time, I'll see you on the next one.